Sometimes bad news makes markets fall. Sometimes the same bad news makes markets rise. Why do stock markets sometimes rise on bad economic news? At first glance it feels irrational. If economic data is weak, growth slows, or unemployment rises, markets should logically fall. But markets don't react only to the economy. They react to expectations about policy, liquidity, and future conditions. That's why bad news can sometimes trigger market rallies. 10 reasons markets can rise even on bad economic news. 1. Bad data can signal future interest rate cuts. When economic data weakens, central banks may reduce interest rates to support growth. Lower rates make borrowing cheaper and increase liquidity in the financial system. Investors often buy stocks in anticipation of this stimulus. 2. Markets move on expectations, not headlines. Investors price assets based on what they expect to happen next. If bad news was already expected, it may not hurt markets. If the outcome is slightly better than feared, markets may even rise. 3. Weak data can slow monetary tightening. When inflation-fighting policies risk damaging growth, weak economic data can pressure central banks to pause rate hikes. Investors view this as positive for asset prices. 4. Government stimulus becomes more likely. Economic weakness often pushes governments to increase spending or introduce support programs. Markets may rise in anticipation of fiscal stimulus entering the economy. 5. Corporate expectations may already be lower. Companies often reduce forecasts during uncertain periods. When actual results arrive and appear less severe than predicted, investors respond positively. 6. Liquidity matters more than growth in the short term. Financial markets are strongly influenced by liquidity conditions. If investors expect easier financial conditions despite weak data, asset prices can rise. 7. Sector rotation changes market dynamics. Certain sectors benefit from weak economic conditions, such as defensive industries or companies with stable cash flows. Capital shifts into these sectors, supporting overall market indices. 8. Short sellers cover positions. When traders expect markets to fall, they may bet against stocks. If prices start rising instead, those traders must buy shares to close positions, pushing markets higher. 9. Global capital flows can offset domestic weakness. International investors move money across borders seeking safety or opportunity. Foreign capital entering markets can lift prices even when domestic economic data is weak. 10. Markets look beyond short-term pain. Investors often believe economic downturns are temporary. If they expect recovery within a reasonable time frame, markets may rise in anticipation of future growth. Final truth. Markets do not react to whether news is good or bad. They react to what the news changes about the future. Sometimes bad news brings policies that markets love.